Hey, welcome to this episode. Dave Gardner here, and I got my good friend Nils Bajczuk from Mount Pacific Bank, and we're here to talk about construction lending. So I know a lot of you have questions about whether it's residential or commercial, and so Nils is here to help us kind of navigate what that looks like and enlighten us on how that works.
Okay.
Nils, take her away.
All right. Well, thanks, Dave. I appreciate the introduction. Yes, I'm a Chief Lending Officer for Mount Pacific Bank. I basically take care of the production side of the lending department. We do all types of commercial lending and residential lending. And when it comes to construction loans in particular, we do the custom home builder or the couple that wants to build their dream home. We do plat financing. We'll do multifamily and just general commercial, warehouse buildings, retail, that kind of thing.
Well, let me pause you real quick.
Yeah,
so
go ahead.
let's cut this into some smaller pieces. So let's talk about I got a mom and pop I'm working with, and they already own their lot.
Okay.
And they're like, hey, you got to call Nils. Take
Yep.
me from there and what that looks like. What's the mechanism? What are you looking for that client?
So the main thing is we need to make sure, we need to know where they are in the process, and usually the big thing is the budget and understanding what the total project cost is, and then
Which is out the window today.
Well, exactly. that gets built in with contingency and whatnot. So depending on how things are going there, that can affect things. But really, we start with the budget and what do they have into it in terms of cost. So you're saying in this case they own the lot free and clear,
Right.
Yeah, that's always a great situation because we tend to want to see somewhere around 20%, 25% ideally of the cost.
So back that up for a minute for me. So house is going to be let's just say it's $1 million build, right? They've got their lot. Their lot's $250 of that $1 million, right? So that gets them 25%.
Yeah.
And then they're going to pledge that lot to you.
Did they pay $250 for the lot, or have they owned it for years?
Hard
and
to
years?
say.
You see, and that's where that comes into play a little bit. With the residential home, it isn't as big of a factor as it is with commercial. So that's part of it, though. We want to know, well, what they pay for the lot.
Gotcha.
Because that's the other part of it too. Is loan to value nowadays is not the end all be all like it used to be.
Okay.
Pre 2009, 8. I hate to bring that up. That it was like, well, let's appraise this thing and see what it's worth, and you don't have to have any cash out of pocket. Well, those days have changed a little bit. Quite a bit. So that's part of the equation.
So it is more of a skin in the game, period, right? It's more of a skin in the game issue, right?
Yes, exactly. So,
Okay.
so we start there, but then once we have that idea and we know how much money they need, what I tend to do is I call up my good buddy Dave and I say, hey, these people are going to need a $750,000 mortgage. Can they afford it?
Gotcha.
We need to know that you can pay me off when we're done, because if not, then I'm stuck holding the bag here.
So what's a bank using for time frame right now?
For construction on a home.
Right.
Custom homes, we're usually looking at like a 12-month build.
Okay.
So we typically want to close that deal when permit is in hand.
Gotcha. Okay, so someone looking to build right now, they're coming to you. They've got to do a lot of legwork up front to get to that point where they can actually submit their permit. Permits are typically good for a year, I think, from takeout. Might be 18 months. Mm-hmm. So the idea is they're ready to get their permit when you're ready to finance them.
Right. And okay. I actually have a great example that I'm working on right now. Now that we think about it, I have a couple that's building a vacation home in Eastern Washington with their kids.
Okay.
And so they came to me months and months ago before they had plans done, before they had anything. And what I did is I got their financial package and did just what I said and basically got them pre-qualified for the takeout portion.
Okay.
And they've been, I've been waiting for them to get the permits and plans done. And then obviously once you get that done, then the contractor gets involved and you get the actual bid.
Gotcha.
And so the bid is kind of the last piece because, costs change, as we know. And so we're waiting, for that. And then once that happens, we can go to final underwriting and sign them up.
Okay. So the mechanisms, now they're off and running, right? They got the permit in hand, contractor's been hired. Talk to me, because a lot of people don't understand the draw request situation. They don't understand inspections, things like that.
Yeah. So the way you got to look at these construction loans from the banker's perspective, and I know we think in a different way, people believe, but the main difference with a construction loan is we're financing something that isn't there yet. Right. And so when you come to us for a loan to buy, a house, and the house is done, well, we know what it's worth, we know what it looks like and all that. And so from a borrower's perspective, you have to realize what we're doing is we're ensuring that every month that we dish out some money for draws, that if 50% of the framing is completed, that we're funding only 50%. So the way that process looks is we're usually always getting third-party inspections. So somebody goes out and inspects the draw request from the contractor. We take a look and make sure that their percentage of completion matches up with what they say it is.
Right.
And then we get a report back from the inspector. And then generally the last part of that equation is lien release waivers. We want to make sure that there's no liens from any of the subs who have gotten paid at the end of the project outstanding. Otherwise, you can't close on your loan.
Right, right.
So that's the other layer of this, and that's why typically there is more work involved. So.
Well, and again, I think from back when we were doing this with the bank, the builders are putting in invoices towards the end of the month. They want to get paid on the 10th. There's a lot of things that happen between the 30th and the 10th to make sure. Right. And none of us want to go back to 2008, 9, 10, those PTSD years.
Yeah.
So again, it's good to hear that the bank is looking at things differently now. I mean, that should help across the board keep a lot of the banking industry out of trouble when we're doing these kind of loans.
Correct. And I should add one thing that we've actually started doing that we've been doing now for a few years, but we actually have a few people in our construction department at our bank that manage and handle the draw requests. So they're very busy end of the month, beginning of the month, because like you said, most draws are due on the 10th.
Right.
And so what we typically do is we actually have the contractor, and let's say we're talking about a custom home, we have the contractor and the owner meet with our construction team.
Okay.
So they have their expectations laid out, and they know what does this process look like.
Gotcha.
A lot of times the contractor will get upset and think, oh, it's too hard to get my money. Well, if they know ahead of time what they have to produce, which is nothing, out of the ordinary, it makes the process just a lot smoother.
Well, communication's key with pretty much everything,
Yep.
right? And then setting expectations. The other part of it is now the homeowner, the eventual homeowner, is part of this process, and they can say, hold on a second on that draw request.
Right.
Something sideways or something's not quite the way it should be.
It's actually, if the bank is protecting the loan, we're protecting the customer as well, and right. I think they tend to figure that out. We're just protecting their interests because their interests are the same as ours. We want
right.
the home to get done. We don't want cost overruns to go crazy. We want there to be enough money to finish it.
Right. So you just mentioned a key word, interest.
Interest. Yes.
So how does a bank establish the interest on a construction loan?
Well, construction financing is always floating.
Okay.
Whether we're talking, when I say always, there's always going to be a caveat to that, but every construction loan we have on our books right now is floating. And so we usually price that off of prime.
Okay.
And as you know, prime has been moving.
And going to move a lot this year.
Correct. So, and we'll spread that around 1.5, 1.25, 1 over prime in some cases, but
okay.
Yeah.
Some of that comes down to bank relationship maybe or just the overall process and project.
Correct.
But and when you say floating, is it floating monthly, annually? I mean
daily.
Daily. Okay.
Yeah, but prime, as you know, the Fed meets now they're going to meet pretty often.
I think they're going to start meeting once a month.
Well, I think that they are. So yeah.
Okay, so let's segue into some bigger projects. So land development right now is if you can find a lot or if you can find the land to develop, obviously we need it. We're right. 5.5 million houses underbuilt around the nation right now, and land development's the start of that.
Yep.
So how does something like most of my clients aren't dealing in that realm, so maybe we did give the big picture.
Okay. Yeah. So really, probably the most risky loan that we underwrite is a land development loan. So just, big picture, somebody's buying 4 acres and they're going to turn that into
20 lots
or
yeah.
20, whatever,
yeah.
right? I mean, it could be 50 nowadays. I don't know, depending where it's
Depends
at.
on where it's at.
That's the riskiest part because those lot values tend to get affected more than anything when prices do turn.
Right.
And so those lots, they may be thinking they're worth $250 a piece, but boy, they can change 50% very quickly, and we both have experienced that. So, what typically on those loans, I mean, we usually want 50% skin in the game.
So back up. So it used to be in my previous life that you really couldn't seek bank financing until you had preliminary approval, meaning your contract with the city or the county. Is that still a deal, or are you doing raw ground? And if you're doing raw ground, is that the 50%? And
well, the 50% is pretty much all the way through until you've got actually completed lots.
Okay.
And so, I mean, to be real frank with you, most of the builders we work with are handling that out of pocket.
Right.
And so they come to us for the vertical.
Gotcha.
That's a lot more typical nowadays than it used to be.
Well, it's unfortunately, the way the regulations have been built over the last 15 years or so, they've really taken out the mom and pop aspect. I mean, it's so cash heavy up front, and we're not talking bank cash. We're talking, real money out of pocket just to get you to certain milestones. Like I said before, you can even go vertical.
Right, and that's really what triggered me asking, well, did they own the lot for 10 years and pay 50 for it? Because we actually have to look at loan to cost. That's the key with all this stuff is loan to cost is everything.
Gotcha.
Whether you're talking consumer or commercial. I mean, that's really where the name of the game is.
So land development is still, heavy cash, heavy outlay, everything else. The bank is definitely risk averse. I mean, we were both in that environment not that long. 10 years ago seems like forever ago, but 12 years ago.
Yep.
And then right now apartments are a huge deal. Multifamily is a huge deal. So we won't even go into the whole condo aspect, but let's just talk about multifamily. Is multifamily, let's talk about that financing.
Yeah, we actually have several projects in Everett right now that we financed. And for instance, one that just got completed, I want to say about 2 months ago, is almost full. And so the demand is definitely still out there. I mean, housing costs are still high. So the people that can't buy, well, they have to rent.
Right.
And so if you have a new product that's desirable, it's, you're gonna attract people. I mean, look at Alderwood Mall with what they're building down there.
Right.
There's a lot of demand around here, and that's what's driving it. And the way we look at it is the demand is real and the sales are real because you have to be able to afford a house to buy one.
Right.
Not like it used to be. And so it's not an artificial demand.
Right.
It's
and it's not artificial guidelines. It's not liar loans. Whether you're on the commercial side or the residential side, on my mortgage side, it's all legitimate. I mean, I get that question all the time. Are we facing 2008 right now? And I'm like, well, it's vastly different when you look at just guidelines and regulations are way different. And you're on the banking side again, dealing with those PTSD moments. And whether it's internal to the bank, which I'm assuming a lot of those things you guys are doing is internal, but you also got the FDIC, breathing down your neck on certain aspects.
Yeah, and going back to the multifamily situation you were talking about, so I had a builder who's building a project in a couple phases, and so the 2 phases are identical in cost. I mean, they've gone up obviously because of lumber and other things like that. But what's changed from the first phase, which we underwrote 2 years ago, is what we're doing now is we have to look at stress testing this thing up front because they have the same basic income coming in from the rents. I mean, those have changed a little bit, but not a whole lot.
Right.
But we got to look at, okay, today he might be able to get, say, today. I mean, geez, if we're talking last week, I mean, the rates have changed almost half a point, really.
Right. Oh, yeah, overnight.
Yeah. So today, let's say we're underwriting at 4.5. We have to say, okay, what does it look like at 5.5 when this guy's done, or even 6?
Right.
Because consequently, we had to lower their loan amount because it wouldn't cash flow.
Gotcha.
So we have to underwrite to a cash. So with multifamily, the big key is you want to have a debt coverage ratio because that's where the rubber meets the road in that, from the investor side and the financing.
So you're going to get them through construction, which again, who knows where we're at a year from now? I mean, we could easily be at 6 on commercials, given what the Fed's talked about, and what they're doing. So is that a 10-year term? I mean, you've got your construction aspect, and then it's going to roll, I'm assuming, into some kind of fixed term.
Yeah, so we always have to offer a mini perm.
Okay.
Because what it comes down to for us is how are we getting paid back? Well, if we have a construction loan that matures in 2 years, they're not going to write us a check for $4 or $5 million.
Right.
Well, some people can, but I mean,
those are the best clients to have.
So what we do is we give them kind of a little bit of slack, and we give them a mini perm.
Okay.
And the reason I say that it's slack is with multifamily, that's a very desirable product in the market that has very low pricing available that we can't really typically do.
Right.
So we'll offer them, a 3 or 5 year. Usually it's 5, but now it's been shortened just because of the way rates have been. And then, typically they'll go out and refinance that.
Well, there's hedge funds out there. There's all kinds of money out there for those. It's a great funding source out. There's plenty of funding sources out there for that product. In fact, I just heard where instead of 1031ing your investment property, you can 1031 into a 1031 fund.
Oh, wow.
That then they are in charge of your 1031 money. So you get out of the landlord business. Right,
yeah,
you're not having to deal with tenants anymore, but those dollars are out there where they're rolling into 200 to 400 units every 5 years or so and rotating your money around. So it's an interesting concept. I just heard about it. It's a Delaware statutory trust.
Oh, interesting.
Yeah.
And I don't want to make it sound like we're trying to push away the business. In fact, we recently we have some means of doing swaps and that kind of thing. But we just haven't done much of that. But
well, the bank's still fairly new. I mean, relatively speaking, started in 2006. It's really gathered a lot of traction, especially since it's one of the few surviving banks locally.
Yep.
You mentioned that one of the houses you're doing is over in Eastern Washington. Is the bank spreading out their region a little more, getting outside of their comfort, or is that just a one-off because of that client?
No, kind of our appetite for loans outside of the area, it hasn't changed. What we're really what we focus on is the actual customer banks with us and lives here, and this happens to be a vacation home over there. So
gotcha.
That's a little different.
That's why I want to kind of clarify that.
Yep.
Local banking means local relationships and really fostering, whether it's business or non-business relationships, it's still fostering local relationships.
Right. And we've spread that footprint out. I mean, we're now, we're Burlington down to Ballard and, everywhere in between. So, Bellingham is not out of our area at this point, and neither is, Seattle. So, I mean, we have a pretty big area.
Well, let's face it. I mean, if you're talking about land development loans, there's not a whole lot going on in any core right now. So, a lot of those developers are having to spread their wings and go to like Gold Bar and Sultan. Who knew, right? These are the new hotbeds of growth.
Cedro-Woolley,
Burlington, and
joked
Bow.
about Cedro-Woolley back. No, it's a big market now.
Yeah, well, and Darrington. I was talking to someone the other day. Said Darrington's really taken off. It's finding its own groove, and it's becoming a little pocket community. And it's like I've been to Darrington for a long time.
Yeah.
And I have some clients out there. So, but no, it's really interesting. So, kind of in a nutshell, the biggest thing with residential construction financing, skin in the game, budget. Ready to pull the trigger when you got your permit, understanding that it takes a lot to get to that stage. Right. There's a lot of outflow of funds that go. I mean, your design, your septics, your sewers, your waters, all those things are pretty much outside of what you're loaning.
Yes, usually yes, because your money is your glue, your skin in the game is going to go in first, and that's going to go towards land and or usually the permit process, the entitlement process. So.
Okay.
Yeah, and there's one thing that I guess we should touch on also that I haven't in regards to the process with somebody building a custom home is we're also going to be very we're going to want to understand the builder, the actual general contractors. We're going to vet that.
Okay. And
so, a lot, that's the other thing we run into a lot is people coming in and saying, hey, I want to be my own general contractor. Well, the flat answer usually is, well, no.
Right.
But, you do typically run into somebody that has maybe some experience with that. That's a little different. But it would have to be very direct experience. So for the most part, we want to understand that the contractor is somebody who's established that knows what they're doing.
Well, and to touch on that, like I'm building my own house right now, but it's not my first time at the rodeo. Right. And luckily, I married well. My wife is really sweet. We get to sheetrock. It's her house. But, but the reality is you hire a GC for a lot of reasons, and a lot of the reasons are just because they've got good subs.
Exactly.
They've already vetted their plumbers and electricians and sheetrockers. They have their budget they can put together. They understand they can go to their top 3, get numbers in, so you're getting legitimate numbers. And it's not, they do it every day. So, for example, right now, if you're trying to build and don't realize that 4 months ago you should have ordered your windows and doors, or 6 months ago you should have ordered your appliances, and you're taking on this path now. I mean, garage doors. I just talked to the inspector the other day, and he said, we've got even builders right now can't get garage doors. Yeah. And it's like, these are the things that people don't realize in the market we're in right now. So to say I want to be my own builder, if you haven't built something in the last couple of years, I wouldn't even attempt it.
Yeah, it is very rare that we'll even take something on like that. It has to be a very unique situation. There's a lot of value added that comes with a good general contractor, and at the end of the day, you're talking about something that you're going to live in for, 10, 20 years maybe, or plus, whatever. Right. I mean, long term, you're better off just making sure you have somebody who knows what they're doing.
Yep. We didn't really touch on it a lot, but you're you're a general contractor builder, spec builder.
Yep.
Right?
Yep.
Banks doing those loans?
Yes.
Okay.
Yep.
So similar skin in the game, slightly different business model maybe?
Yeah, we're seeing a lot of different things in the market, but like I said, generally speaking, the builders we're working with, a lot of them are coming to us with lots that we just do the vertical. But the skin in the game, I mean, we'd like to see a minimum of 20%.
Right.
If you have the land in aspect already, you're going to have at least 20%.
Oh yeah.
But we also have some builders who are we have finance more than that. But the other thing we're finding out is that gives us a comfort level is if we have a builder who has a lot of liquidity, who has the means to support a project if something does go wrong. So that's the other thing, if there's outside cash and investments that the builder has that they may not, we're not going to ask them to use, but we know they have available, they don't have to look to us if there's a problem.
Right. Well, and it's pledged on their financials. You guys are getting a full credit portfolio on somebody. I mean, this, going into 2008, it was a different world. Oh, yeah. And again, I know specifically Mountain Pacific Bank and the group that you are affiliated with inside and on the board and everything else. They're very aware, and they have very long memories of what what had to happen from 2009 forward to make sure the bank didn't get in trouble.
Yeah, there were guys with a Ford F-250 and a cell phone belt clip, and they were builders.
Yeah, plumbers, electricians, everybody was a builder back then.
Yeah, so it's a lot different.
Yeah, so the vetting process is a lot deeper, but again, for a reason, and I think any of your builders all know that too.
Oh yeah, they do.
Well, Nils, thanks again for coming in. I think that's great, kind of bird's eye view on what's going on with construction lending. So I do thank you for taking some time out and coming in.
You're very welcome, and thanks for having me. Appreciate it.
If you need a construction loan, Mountain Pacific Bank, call Nils. You'll get a hold of him, and he can at least help you vet through the process.
Definitely can. Thank you.